Thursday, January 2nd, 2020, Maneco 64, home of alternative economics and contrarian views. So the People's Bank of China, or the Chinese Central Bank, has joined the party at the beginning of the year. They've pumped $115 billion into the market overnight. So it's not only the Federal Reserve. Federal Reserve, of course, pumped $255 billion in the last day of the year into the repo market. Repo market was trading at 188, that rate in the repo market, the overnight rate, and they drove it down to 155. So as you can see here, there's a story in the FT from a couple of days ago. Fed curbs repo volatility on final day of 2019. So central banks around the world, China included, are trying to kill volatility, trying to keep asset prices high. So I'll go over the Chinese story here in the FT, then I'll look at the markets, see what they're doing this morning. PBOC stimulus gives Chinese stocks New Year lift. Just before I start, let's have a look at where the Chinese stock market is. So the Shanghai index was up 1.15% right now. The Shenzhen component is up 2%. China A50 is up 1%. Shanghai is up 1.2%. And the Hang Seng is just over 1%. So let's continue with the story. FT says CSI 300 index was boosted after the central bank pumped $115 billion into the financial system. So in the last few days, you've got the US Fed, or the New York Fed, pumping in 255, and now you've got the Chinese central bank pumping 115 billion. So nothing's changed. If anything, it's getting worse in terms of all the money into the markets. I've never seen this before. I worked for over 20 years in the markets. Granted, it was a while ago, but this kind of thing never happened. You didn't have central banks having to pump in hundreds of billions daily into the market. So let's go through the story here in the FT. Chinese stocks hit an almost 2-year high on Thursday after the central bank moved to boost economic growth. Well, it's questionable whether that will really boost organic growth, but let's continue. By pumping $115 billion into the country's financial system, the CSI 300 Shanghai and Shenzhen listed companies rose 1.5% on Thursday, the first trading day of 2020, to hit their highest level since February 2018. That came a day after the People's Bank of China cut the reserve requirement ratio for commercial lenders across the board by 50 basis points, or 0.5%, to release around 800 billion renminbi, or $115 billion of fresh liquidity into the banking system ahead of Chinese New Year later in January. Meanwhile, a new survey showed continued growth in China's manufacturing sector. So what's the reserve requirement rate? Well, that's the rate that banks, the rate at which the banks are forced to keep reserves. Let's say 10% reserve requirement ratio. I'm not sure where that ratio is right now, but they've cut it to like 9.5. That's what they've done. That's how they released all that money. Banks don't need to keep as much money on reserves. That's what the Chinese do a lot of times. The Chinese central bank. Analysts said the PBOC moves, which had been expected, would reduce banks' funding costs as well as freeing up credit for private companies and small businesses. So there you go. It's not only the US and European central banks accommodating the credit system, it's also the Chinese. There's also a story here that I thought was interesting about Europe. In the FT, festive cheer sends Eurozone bond yields to fresh highs. Signs that Germany is contemplating higher borrowing have added to selling pressure. I don't think that's going to be a problem because all that will do is that will force or make the ECB probably increase the size of QE they're doing. I think this is what the ECB was looking for because they're running out of bonds that they could buy for their QE. But if Germany is going to borrow more, yes, right now there's selling pressure. The German 10-year bond yield has risen from minus 36 basis points to minus 19. But all I think this is going to do is going to give the ECB the chance to buy, to keep buying, because that's what they wanted. And these yields, I think, are going to go back down, in my opinion, the European yields. So I don't think it's because the European economy is looking a lot better. If anything, it's more of a technical move. So what does it say here? Last year, investors piled into the safest government bonds, betting that a global recession was imminent, pushing yields on more than $17 trillion of debt around the world below zero by the end of August. Since then, an improvement in economic data, I would kind of question that statement, has made fund managers increasingly uncomfortable about buying bonds that guarantee a loss if they're held to maturity. The Eurozone, and particularly German bonds, bore the brunt of late year selling thanks to the region's deeply negative yields. The other thing as well about buying negative yielding bonds is that it's a little bit like a bubble. It's a game of musical chairs. You get in, yields keep going lower. As many of you know, as yields drop, prices go up. But there comes a point where people, they go and sit down and need to start selling those bonds. And when you start selling them, especially the deeply negative and long-term bonds, their prices drop quite sharply. They're a lot more sensitive. The longer-term bonds with very low rates or negative rates, they're a lot more price sensitive, and you get this rush out of bonds. We'll have to see. This could be a problem as well. Even though I said that the ECB could come in and start buying more, and I think they will if yields start backing up too quickly. So, very interesting start, I would say. As I said, the Fed also was very busy on the 31st. Yields or the repo rate was quite high, almost up to 2%. Of course, it wasn't as high as it was in September when we reached 10%, but they had to drive it down, calm the market down back to 155. The repo rate, they're not out of the woods yet. Will be an interesting start of the year. So now you've got the Fed, the PBOC, and I expect the ECB to join the party of easy money. Bank of England still not doing much at the moment. I think we do have, I guess, a new governor coming in soon. I'm not sure when he comes in, Andrew Bailey, and we've got Mark Carney going out. So now let's look at the markets. It's 8:18 a.m. London time. So right now, spot gold is up just over $2 at 15.20. Range has been 15.16 to 15.22. So pretty much in the middle of the range, I would say. Silver kind of quiet, only up 3 cents at 17.87. Range has been 17.78 to 17.98. The Dow, not surprisingly, with the action of the Chinese, is now up 1/3% or 86 points at 28,650. S&P up 1/4%, 32.42. Nasdaq 100 future up 1/3, 87.70. In the currency market, fiat currency market, Cable or sterling is down 0.25% at 132.20. The euro is unchanged, 112.10. And the dollar yen is unchanged, 108.79. And the dollar against the yuan is pretty much unchanged as well at 6.96. Crude oil, WTI, unchanged at 61.20. And Brent also, actually, Brent slightly higher at 66.33. Let's finish off with the bond market. Why is the bond market important? Why do I cover the bond market? Well, U.S. Treasuries, the Treasury yield on the 10-year is considered the risk-free rate of return. I know it sounds funny, but that's what it's considered. And a lot of asset prices are priced off the risk-free rate of return. That's why it's important to look at bond yields. Yes, Treasury yields have risen, especially on the longer end, since a couple of months ago when we went down to around 140. We're now at 194. A 10-year yield is up 3 basis points overnight. Of course, the 2% level is going to be key. Need to keep an eye on the 10-year yield. It could be disruptive for stock markets if yields start rising too quickly. With that, I'm going to finish for today. If you enjoyed this video, make sure you hit the like button. If you haven't subscribed to the channel yet, please think about subscribing. You can also follow me on Twitter, BitChute, DTube, and Steemit. I wish you all a great day. Take care. Bye.